Welcome to this deep dive. We're exploring the Canadian financial marketplace today, specifically focusing on the key concepts you'll really need, particularly if you're gearing up for the Investment Funds in Canada exam.
Right, the IFC. Chapter 2 is a big one for this stuff.
Exactly. Think of this as getting you inside the mechanics of how money moves, how it's managed here in Canada, the foundational bits.
Yeah, and our mission today, drawing on these student notes, is really to unpack that. How capital flows, how it's managed.
Because understanding that framework is, well, it's essential, isn't it?
Absolutely. It's not just about passing the test, though it certainly helps there. It's about grasping the whole environment where investment funds actually operate.
Okay, let's dive right in then. First topic, capital. We hear the word all the time, but what are we actually talking about here?
Good place to start. So the capital at its core is really wealth. Wealth that can fuel economic growth.
Okay.
And the notes we're using break it down nicely into two types. First, you've got real capital.
The physical stuff.
Exactly. Buildings, machinery, infrastructure, things you can, touch.
Right.
Then there's representational capital. That's your financial assets.
Right.
Stocks, bonds, mutual funds.
Ah, so the paper assets, kind of?
Sort of, yeah. They represent a claim on that real capital
Hmm.
or maybe future earnings.
So why is getting this distinction and capital itself so important? It can feel a bit theoretical.
Well, think of it like fuel. It's the fuel for the whole economic engine.
Okay.
Capital makes it possible to finance new projects. Building things, R&D for companies, government initiatives.
Right. Everything needs funding.
Precisely. And for you, looking at investment funds, capital is the pool of money those funds draw on and invest. It's where potential returns come from.
Got it. Fuel for the engine. Now, this capital, it doesn't just sit still, does it? The notes mention some key characteristics.
No, definitely not static. Three big ones stand out. First is mobility.
Mobility.
Yeah, capital can move fast across regions, across borders, looking for the best opportunities or the safest havens.
Like investors shifting money between sectors.
Exactly. If tech looks hot, money might flow out of, say, older industries into tech.
Yeah.
And for Canada, our markets are relatively small on a global scale, right?
Mm-hmm.
So large capital flows, maybe reacting to global events, can really move the needle here. Creates opportunities, but also a volatility you need to be aware of for the exam.
Okay, chasing returns or avoiding risk makes sense. What's characteristic number 2?
Sensitivity. Capital is very reactive.
To what?
Economic news, the interest rate changes, inflation numbers, and political events too, elections, global conflicts, all that stuff influences where capital goes and how much it's worth.
So if the Bank of Canada hikes rates,
Bingo. That could make bonds look more attractive than stocks, maybe, for some investors,
leading to shifts.
leading to shifts in investment strategies, yeah. Something to keep in mind when you're evaluating fund options later.
Okay, mobility, sensitivity. What's the third one?
Scarcity. This is fundamental.
Scare.
Basically, there's almost always more demand for capital, more projects needing funds, more people wanting loans than there is available supply.
Right, never enough to go around.
Pretty much.
Yeah.
And that scarcity is why efficient allocation is so critical. It's why we have financial markets intermediaries,
Right.
all trying to connect the haves with the need-tos.
Okay, so capital. Mobile, sensitive, scarce. Now, who are the main players? Who's got the capital and who needs it?
Yeah, the notes categorize them simply as sources and users. Let's start with the sources, the suppliers of capital.
Okay, who are they?
Well, first, individuals, retail investors.
Everyday people saving money.
Exactly. All those savings in bank accounts, mutual funds, stocks, bonds, RSPs, TFSAs, individually maybe small, but collectively it's a huge pool of capital.
Yeah, the power of the crowd. Who else supplies capital?
Non-financial corporation.
Right.
When a company makes profits, those retained earnings, that's internal capital they can reinvest.
Right.
Or if they have surplus cash, they might invest it in the market themselves.
Okay. And governments.
Governments too, yeah. If they run a surplus, take in more than they spend. They can use that to pay down debt or save for future investments. Think big infrastructure projects we see across Canada.
Makes sense. And the last source.
Foreign investors. Capital flowing into Canada from outside.
How does that happen?
Two main ways. Foreign direct investment, FDI, where foreign companies invest directly in Canadian businesses, and also foreign purchases of Canadian securities, stocks, bonds.
Why Canada?
Well, generally our political stability is a plus, and our natural resources are often a big draw for foreign capital.
Okay, so that's the supply side. Individuals, companies, governments, foreign investors. Who's on the demand side? The users, the borrowers?
Right, users. Individuals again, but this time as borrowers.
Like using credit cards, getting loans.
Exactly. Credit cards, personal loans, and especially mortgages for homes, cars, major uses of capital.
And businesses.
Businesses are huge users. They need capital for, well, everything. Day-to-day operations, that's working capital, funding expansions, investing in long-term projects.
Where do they get it?
From their own profits sometimes, or they issue shares, sell bonds, take out bank loans. Lots of avenues.
And governments are borrowers too, right? Big ones.
Oh, absolutely. The federal government issues treasury bills, T-bills for short-term borrowing, and marketable bonds for longer-term debt.
Provincial governments.
Very similar. They issue their own bonds and other debt, often using groups of investment firms, syndicates, to manage the sale.
And local municipalities.
Yep. They also borrow, usually through long-term debentures, which are like bonds, to fund local infrastructure. Roads, sewers, schools, that kind of thing.
Okay, so we have savers supplying capital, borrowers using it. But how does it actually get from one to the other? That brings us to financial instruments, I guess. Definitely key for the exam.
Exactly. Financial instruments are the bridges. They connect the savers and the borrowers. The notes lay out the main types.
Let's start with debt instruments,
Yeah.
fixed income.
Right. Think of these essentially as loans. You, the investor, lend capital to a government or a corporation.
And they promise to pay it back.
Yes. They promise to repay the original amount, the principal, at a specific future date, plus regular interest payments along the way.
Examples.
Bonds and debentures are common, typically longer term, like 5 to 30 years or more. Treasury bills, or T-bills, are short-term government debt, under a year. And commercial paper is short-term debt from corporations.
Are there risks involved?
Oh, definitely. There's default risk. The borrower might not pay you back. Interest rate risk. If rates rise, the value of your existing fixed-rate bond might fall.
Okay.
There's also reinvestment risk. You might not be able to reinvest your interest payments at the same high rate. And inflation risk. Inflation could erode the real value of your returns. These are really important concepts for fixed income.
Got it. So, for instance, if you hold a long-term government bond and rates shoot up, your bond might be worth less if you try to sell it before maturity.
Precisely. That's interest rate risk in action, a key point for the exam.
Okay, what about the other big category? Equity instruments or stocks?
Yes, equity. This represents ownership in a company.
So if I buy shares, I own a piece of the company.
A small piece, yes.
Yeah.
Common shares usually give you voting rights on certain company matters.
And the potential for dividends.
Dividends being?
A share of the company's profits paid out to shareholders. Not guaranteed, though.
How do you make money from stocks?
Two main ways. Capital gains if the stock price goes up and you sell it for more than you paid. And dividends if the company pays them.
And the risks here?
Well, market volatility is a big one. Stock prices can swing up and down a lot. Then there's business risk. The company itself might perform poorly or even fail.
Like if a Canadian company relies heavily on oil prices and oil tanks?
Exactly.
Yeah.
Like business risk affecting their profits and stock price. Good example. And there's dividend uncertainty. Companies can cut or stop paying dividends.
Okay, now really central to our focus, especially for the IFC exam, investment funds, mutual funds.
Absolutely key. Investment funds pool money from lots of different investors.
And a professional fund manager takes that pool and invests it in a portfolio, a mix of stocks, bonds, other securities based on the fund's specific goals.
What are the advantages for someone like me?
Well, professional management is one. You're hiring an expert. Diversification is another big one. Your money gets spread across many investments, which can lower risk.
Easier than picking stocks myself.
Often, yes. And they're usually easy to buy and sell.
Yeah.
But there are downsides.
Fees?
Management fees, yes. They reduce your overall return. And performance varies. The fund's value can go up or down. There's no guarantee. Understanding these trade-offs is crucial for the IFC.
Right. Then we have derivatives. These sound more complex.
They generally are, yes. A derivative is a contract whose value is derived from something else, an underlying asset.
Like a stock price.
Could be a stock price, a bond yield, a market index, even a commodity price.
What are they used for?
Often for hedging, basically, managing risk, like insurance against price drops, or for speculation betting on future price movements. Options give the right, but not the obligation, to buy or sell something at a set price later. Futures or forwards oblige you to buy or sell at a set price later.
So riskier.
They can be, yes. They involve leverage and complexity, usually more for sophisticated investors who understand the risks. Less of a core focus, maybe for the early stages of IFC, but good to know. They exist.
And the notes mention a few others briefly.
Yeah, it just touches on them. Structured products, they combine features of different instruments, often linking returns to something else.
Oh, okay.
Exchange-traded funds, ETFs, they're like mutual funds in that they hold a basket of assets, offering diversification, but they trade on stock exchanges, like individual stocks.
And linked notes.
A type of debt, but the return isn't fixed interest. It's linked to how some underlying asset or index performs.
Okay, so those are the instruments, the tools connecting savers and borrowers. Where does the actual trading happen? Financial markets, another big exam topic.
Absolutely. Financial markets are the venues, physical or electronic, where these instruments get traded.
What's their main purpose?
Three key things, really. Efficient capital allocation, connecting buyers and sellers effectively. Providing liquidity, making it easy to buy or sell without tanking the price. And price discovery, letting supply and demand determine fair values.
Are there different kinds of markets?
Yes, we can slice them a few ways. One useful way is by the maturity of what's traded.
Okay.
You have the money market. This is for short-term debt instruments maturing in under a year.
Like T-bills and commercial paper we mentioned.
Exactly. Generally lower risk, very liquid.
And the other type.
The long-term capital market. This is where stocks and bonds with maturities over a year are traded. It's crucial for funding corporate growth and longer-term government projects.
We also have markets for those other instruments.
Right. There's the derivatives market, where options and futures trade. In Canada, the Montreal Exchange is big for financial derivatives. I see Futures Canada for agricultural ones.
And foreign exchange?
Yep. The Forex or FX market. That's the global market for trading currencies.
Yeah.
Huge, but maybe less direct focus for basic investment funds initially.
Okay. The notes also make a distinction between primary and secondary markets. What's the difference there? Crucial for the exam, I bet.
Definitely crucial. The primary market is where new securities are issued and sold for the first time.
Like an IPO.
Exactly. A company's initial public offering of stock happens in the primary market. Same when the government issues new bonds, or when a mutual fund creates and sells brand new units to investors. It's the first sale, from the issuer to the investor.
Okay, the first time it's sold. Then what's the secondary market?
The secondary market is where existing securities ones already issued in the primary market are traded between investors.
So when I buy shares of Bell Canada on the stock exchange...
That's the secondary market. You're buying from another investor, not directly from Bell. This market provides that vital liquidity, letting people sell their investments and helps determine the ongoing value. Understanding this is key for how funds are bought and sold after launch.
Primary, new issues. Secondary, trading existing ones. Got it. Now, with all this buying and selling, we need rules, right? Regulation, another key IFC area.
Oh, absolutely essential. Regulation maintains market integrity and protects investors. Canada has a layered system. Federal, provincial, territorial, and self-regulatory organizations, SROs.
Let's start federal. What's their role?
The federal government sets broad frameworks. Things like the Consumer Protection Act and the Criminal Code have clauses against financial fraud.
Okay.
The Bank Act governs the banks, obviously major players, and the Canada Business Corporations Act sets rules for companies issuing shares. It impacts the supply side.
But the provinces seem really important for securities.
They are, hugely. Each province and territory has its own securities commission, like the OSC in Ontario, the ASC in Alberta.
What do they do?
They oversee the securities industry in their province. They register dealers and advisors, set disclosure rules for companies selling securities to the public, and enforce the rules against things like insider trading.
Main goals.
Investor protection, first and foremost. Ensuring fair and efficient markets. Maintaining public confidence. Their oversight is critical for investment funds and advisors.
Okay. And then these SROs, self-regulatory organizations, what are they?
SROs are industry bodies that the provincial commissions delegate some regulatory power to. They're like the frontline regulators for their members.
Give samples.
The MFDA, Mutual Fund Dealers Association of Canada. They supervise mutual fund dealers and advisors everywhere except Quebec. They enforce rules on suitability, making sure advice fits the client and disclosure.
Right.
Then there's IROC, the Investment Industry Regulatory Organization of Canada. Broader scope. Overseas dealers trading stocks, bonds, funds. They also monitor market trading activity.
And Quebec is different?
Slightly, yes. In Quebec, the AMF, Autorité des marchés financiers, has a more direct, integrated role across the financial sector, including funds. And the Chambre de la Sécurité financière also plays a role with advisors. Just be aware of that difference.
So it's a pretty comprehensive regulatory net, it sounds like.
It aims to be,
Yeah.
yes, it's complex, but the goal is to create trust and a level playing field, protect investors, and keep the markets functioning properly.
Whether you're saving for retirement or a company raising capital.
Exactly. Understanding this framework is, well, it's foundational for anyone working with investment funds in Canada.
Okay, well, that feels like a really solid grounding in the Canadian financial marketplace. We've hit on capital, the players, the instruments, the markets, the regulators.
All the key pieces.
And you can really see how interconnected it all is. Absolutely vital context for understanding investment funds specifically, especially if you're prepping for that IFC exam.
Absolutely. Knowing these basics, how capital moves, who does what, the rules gives you the context for the specifics of funds, how they're built, sold, managed, regulated. It all fits together.
So as you continue studying, really try to think about these connections. How does capital sensitivity affect fund values? How does the secondary market provide liquidity for fund investors? How do SRO rules impact the advice you might receive? It's all linked.
Great point. Seeing those connections is key.
Okay, so to leave you with something to think about, considering everything we've discussed about capital's mobility and sensitivity, how might unexpected global events, say, a major geopolitical shift or a sudden technological breakthrough ripple through the Canadian financial marketplace, and specifically impact the different types of investment funds available here? Something to mull over. Thanks for joining us on this deep dive.